It's time to take a look at mega cap tech. Let's welcome in George Tsilis, senior markets correspondent, to join us to talk about that. George, thanks so much for joining us. So to Kevin's point, or Jeff, one of the two, we just talked about the fact that an NVDA, say for example, was down about 6% today, but still up 14% on the week, which really just goes to show how good of a day yesterday was. But overall, if you take a look, tech and consumer discretionary, the two worst performing sectors so far this year, and once again today, one of the worst as well.
I mean, definitely. I think, there's a lot going on right now, to say the least. I mean, everyone's quite aware of what's happening, but within the internals, I think, of the technology stack, there's some interesting things happening. Obviously, if you look at this last week, the China-sensitive names, Apple, for instance, still down 6% this week. NVIDIA, on the other hand, also, as you mentioned, higher. Broadcom, these are two of the lead architects in the artificial intelligence, semiconductor, and software system space are higher. Then the less sensitive digital-driven stocks like Google and Meta, and even actually, if you look at Amazon, is higher. All those stocks higher by between 1% and 2.5% this week. But I think within the context of all this is semiconductors, because one of the things you have to keep in mind is semiconductors are quite a leading indicator. In fact, if you look at a one-year chart of the SOX, SOXX, you can actually see it peaked back in July of last year. And one of the things I noticed this week is amongst all the volatility, which has been tremendous, I'm profoundly just blown away with what's happening this week. Semiconductors as a whole are relatively flat. They're performing better than consumer staples. And so for what it's worth, I think this market is really trying to carve out a bottom with the most sensitive technology names holding up rather well, considering the broader markets and the volatility that we're witnessing.
But wait, the SOX was down 8% today, so make that make sense.
It is. It's down 8% today, but if you look at it on a one-week basis, it's actually flat. We have to consider yesterday's move to the upside, today's move to the downside. But if you strip away all this like two-day volatility and look at it in the context of where we've been in the last 4 days, it's actually holding up quite well. I know it seems like it's not just because of the whipsaws that we've seen in the past 2 days, but it seems to be that they're performing a little bit better than, let's say, the more politically sensitive areas of the marketplace right now in the tech space. And I'm going to focus on Apple there, and then second Tesla. But Tesla's got some other issues associated with valuation. So that's also another factor involved in what's happening in this market. Already, irrespective of tariffs, this market was already priced for perfection. It was probably due for a correction, a 10% one. I think the tariff just added to this, especially in the last week or so, with an additional 10% decline. But we can see that there's appetite for risk-taking, assuming that the tariff resolution comes to be positive. In other words, China right now is the issue. If we can get some resolutions on China, I think this may speak towards the semiconductor names really starting to reaccelerate back to the upside. It doesn't mean we can't go lower from here. We certainly can. You have to be mindful of that, but we have to just basically take things day at a time. Or as even Kevin mentioned, minute by minute. He's right. When you look at things on an intraday basis, the volatility has been tremendous.
All it takes is one Truth Social post. So you mentioned Apple. Apple shares closed down 4% today, so still up 1% on the week. That one was interesting to me because it took part in the rally yesterday. Aside from the fact that it does have a lot of exposure to China, Dan Ives, who once was a big Apple bull, still has a buy rating, but scaled back that price target, said it's the most exposed tech company in a trade war with China, and it still rallied despite the fact that China has, now we understand, 145% tariff rates in terms of imports from there. So do you think that Apple is maybe susceptible to some further weakness because of that? I mean, it is down more than 20% year to date.
Yeah, I think as a barometer, Apple is really the focal point of what's happening in China, just because they're not able to, of course, produce phones quickly from overseas, allies and other nations, places like Vietnam and so forth. So I think if you look at who's losing the worst in this situation, you have to look at China stocks. Many of them, like Alibaba, in the last trading week is down about 20%. NetEase, Baidu, all down 10+% in the past week or so. So they have the most to lose. I just think that concessions will eventually be made by China. The other avenue they would take in another situation, a different situation, is they would devalue their currency, and I don't see them doing that. And the reason being is they have started to internationalize their currency by issuing renminbi-denominated debt to foreign countries. So they don't want to risk that. So my suggestion is that this will pass in some resolution on tariffs, not from another extreme event like a devaluation, which is certainly a possibility, but I don't think it's a probability that we have to take into consideration at this moment.
Okay, and finally, the biggest loser so far this year of the Mag 7, of course, is Tesla. Shares down some 37% year to date, almost 50% away from the highs. Does that mean it's the biggest tariff loser of the Mag 7?
Well, I think it was the biggest political gainer and then the political loser. And I don't necessarily think it has the worst exposure internationally. For instance, they produce where their domestic sales occur. That's good from a tariff standpoint. Supplies, of course, supply chains can impact them. But I think Tesla is interesting here because like you said, it retraced all the way from the 490s all the way down to 217. And that was over a 50% decline. But it is actually holding up quite well in this market in the past couple of weeks on a relative basis.
Okay. Yeah, still up about 5% this week. But hey, China's saying, the Film Association is saying Chinese people don't want to watch Hollywood films. It makes you wonder if they're going to want to buy American cars, even if they're made in China. We'll have to see. Thanks so much, George Tsilis.